Are you feeling anxious because something bad can happen to our economy? I get it. With all the high inflation, interest rate hikes, bank failures, and the unstable situation in the world. But the reality isn't that bad. That's why today we will see how everything is connected in this big game. What should we expect from the economy in the near future, and how you can use your time and money to make the most out of the situation. Listen, 38% of Americans believe our country's biggest problem is the economy, and 14% of them blame inflation. I feel like the biggest issue we're facing now is the uncertainty, and it didn't start today. When did it start then? Well, we could go back to the Fed's creation in 1912, or the 2008 crisis when the age of cheap money began. But instead of going that far, let's go back to 2020 when COVID-19 started. So, it's the beginning of 2020. The coronavirus is spreading around the world. It reaches the US, and there we go. Quarantine restrictions, total lockdown, and a paralyzed economy. Imports and exports slowed down. Restaurants and offices closed. People were stuck at home. Not only the economy, but the whole world stopped. And because of that, most companies suffered huge losses and laid off their employees. And even though many discovered the perks of remote work, there was a major issue: unemployment. It reached almost 15% at the time. The inflation, though, was still very low, at just over 1%. Now, let's fast forward to the middle of 2021. Quarantine restrictions are slowly being lifted. And what happens? Businesses get excited and start hiring. The number of open positions grows, and the unemployment falls to 6%. But inflation rises to 5%. Why? It's pretty simple. Imagine if I stay home without work and a stable income. The first logical thing I will do will be cutting my expenses. And that's what most of us did during the quarantine, because we didn't know what was going to happen. As a result, the demand for goods and services dropped. But when Americans got back to work, they started earning again. And now they could spend more, whether on gas to get to work, their lunches, or any other everyday expenses. But here's the twist. When the demand went up, prices increased too. Another reason for higher demand was that some people earn more when working remotely. Did you know that remote workers earn, on average, almost $9,000 more per year than those in the office? How's that possible? The main reason is that those working from home tend to have several jobs. In 2022, nearly 80% of remote employees had at least 2 jobs. That's how 34% of them managed to earn over $100,000 yearly. But the booming labor market and low unemployment were not the only reasons for higher demand. 2 other things that led to it were the cheap money with near zero interest rates and the government stimulus of over $5 trillion. As a result, we got an overheated economy because there was too much money out there. That was also why we saw so many companies getting sky-high valuations, which were not realistic, by the way. So it was just a matter of time for inflation to get out of control. So the big question is, how do we slow down this train? The standard recipe is to cut people's earning and boost unemployment. This could work because lower income and lower demand can stabilize the situation. But who can make this happen? And how? Here is when the Federal Reserve steps in. And their main instrument is adjusting interest rates. So, to cool the economy down, they raise interest rates. This means that loans get more expensive, not only for us, but also for businesses. And what do businesses do in response? They start optimizing their expenses. This often leads to salary cuts and layoffs. And even if they don't fire people, they certainly are not in a rush to hire. But the main challenge for the Fed is to balance their policies, because they're also responsible for ensuring maximum employment. Although in reality, the maximum shouldn't be reached if we want stability and low inflation. So they have to play around with the rates and make them tight enough, but not too tight. So what's the situation now? We all know the Fed raised interest rates several times this year. Now it's over 5%, at its highest level since January 2023. But the unemployment is less than 4%, which is much lower than expected. Why is that? One big reason is that many businesses still need to fully recover from the pandemic losses, and laying people off again is a risky move. Plus, because of remote work, companies are saving big time on office space, so the need to cut down on jobs diminishes. Now, it seems like for businesses, high rates are more of a complication and not a deal breaker, at least at this point. Still, inflation doesn't go unnoticed. It is far from that. In fact, a CNBC survey shows that 92% of Americans cut back on spending, and this year's Black Friday might be just confirmation of that.
5-10 years ago, a lot of people would be out here already getting ready for those morning big deals.
Many consumers squeezed by persistent inflation and high interest rates. U.S. holiday spending is expected to rise at the slowest pace in 5 years.
And that's just with retail prices. An even bigger question is, what will happen to assets like real estate? Many are not sure if they will be able to afford their mortgage if both interest rates and prices keep increasing. For those wondering about the real estate market and its future, let's see what we can expect. At this point, most experts say that we have two possible scenarios. The first one suggests that more people won't be able to afford their homes. So we can see cheaper properties flood the market. But nothing really indicates this, at least for now. The second scenario is completely the opposite. Many Americans might want to change houses, but they won't sell their current property because they have locked a low interest rate. So in this case, the real estate shortage will continue. For now, both homes and rent prices don't seem to drop. And because everything else seems to get more expensive, the logical question is, why not just print more money and increase salaries? Having more dollars in the economy is a good thing, right? Not exactly. You see, more cash in hand means more spending. And what does that do? Well, people start needing more things. So companies have to produce more. This drives up the production costs and the consumer prices grow as well. Simply put, when the government prints more money, inflation goes up. And printing more money doesn't mean creating more value. This is important because the only way for any economy to grow is to generate added value and increase its GDP, which is the size of the economy. But if we simply print more money, there will be no new businesses, new job openings, or new exports. What's the end result? Price increase. Plus, imagine if the media starts talking about active money printing. Everyone will panic. Then people will convert dollars to gold and other currencies. And the more people do it, the weaker the greenback gets. Speaking of the devil, these times are also tough for American banks. Take Silicon Valley Bank, for example. They went big with the US government bonds, which is usually a super safe bet. But the Fed hikes rates and boom, those bonds lose value. Investors panic and start pulling out their cash fast. The result? The bank's stock plummet by over 60% in one day, and the bank files for bankruptcy.
A rough week for the banking industry.
The collapse of Silicon Valley Bank. The second biggest bank collapse in U.S. history.
It wasn't just SVB. Other regional banks got affected as well. Many said that it was the start of a banking crisis. But as we see, the situation has stabilized, at least for now. And if you think that we might be repeating the 2008 crisis, I explain my opinion on that in this video. So check it out after watching this episode. But now the main question. What is waiting for us? A recession or a soft landing? That's the million-dollar question. Not easy, but let's dive deeper to get the full picture. Some might think, how can I not panic if banks are crashing, prices are through the roof, and everyone keeps talking about a recession? The economy must be collapsing. Look, nothing is collapsing. Not now, for sure. As for recession, let me show you one thing. Out of the 13 Fed rate hikes since the 1950s, only 7 led to recessions within the next 18 to 20 months of the first hike. And out of those 7, not every recession was long and dramatic. Even though the media tries to scare us with a recession like it is some kind of a monster, in reality, a recession is when the GDP, meaning all the goods and services produced, declines for 2 consecutive quarters. You heard that right. I said decline. I didn't say destroy. Picture this. You're jogging and you get out of breath. What do? You slow down to catch your breath. But then you pick up the pace again and keep running at a new speed. You don't stop and throw the towel. That's exactly what the economy does in a recession. It slows down, it adjusts, but keeps going. Now, let me bring you back to the brighter side of things. Since the Great Depression, the US has seen 14 recessions. The average one lasted 10 months and usually led to a 2.5% drop in GDP and 4 million job losses. But when the recession is over, we usually see a very big economic bounce with up to 69 months of growth, a 25% GDP jump, and 12 million new jobs. And every recession tends to ease the inflation, normalize prices, create new businesses, and make existing companies stronger. So what's the message here? The economy is like a roller coaster with constant ups and downs. And even though now everyone tries to predict when a recession might be coming, it is still very unpredictable.
Recession's going to come when? Not October. So you got October, November, December, January, February, March, April, May, June, July, August. August of next year.
But what if the Fed misses that soft landing and recession comes? Then we should be prepared. How can you protect yourself? Well, the first thing you need to do is to sit down and assess all of your expenses and earnings. Then think if you can increase your earnings and reduce your expenses. This doesn't have to be something major. Even small things can make a big difference in the long run. Create an emergency fund that ideally covers at least 3 months of your usual expenses. If you have an investment portfolio, check it out and do 2 things. Diversify and keep a portion of your wealth in liquid investments. This way, you will be able to use your money quickly if an emergency occurs. Avoid risky investments, or at least don't allocate more than 5% on them. Try to pay off your personal debt, starting with credit cards, and do your best to not get into more debt. Invest in your professional skills to make you a stronger candidate in the job market. And remember to educate yourself in the financial sector, because our panic often comes out of the lack of knowledge. Last but not least, remember recession is a reset that always makes the economy stronger. If you discover something new today, share this video with your loved ones. See you in the next video. Bye-bye.